Welcome back to The Deep Dive. We're here to cut through the noise of earnings season, and today we're digging into American Axle and Manufacturing, that's AXL, and their Q3 2025 results.
Yeah, and this is a really interesting one. AXL's in a complex spot trying to pull off this huge Dowlais merger while, the whole auto world is shifting under their feet.
Absolutely. So if you're holding AXL or just tracking the auto supply chain, this deep dive should give you the essential insights.
Right, because you've got moderating EV demand, trade policy shifts, inflation.
Yeah.
It's a lot. But these Q3 results, they really show some strong operational grip. The market definitely noticed that.
Yeah, that market reaction was immediate, wasn't it? It suggests folks basically ignored the slight miss on the top line.
Completely. It was all about the core stuff, how efficiently they ran the business.
Okay, so let's start there. Give us the quick snapshot. What were the headline numbers that caught the street off guard?
Well, the big one, undeniably, was the profit beat. Adjusted EPS came in at $0.16.
16 cents. And consensus was what, around 12?
Closer to 12, yeah. So like a 33% beat on earnings. Pretty substantial.
Okay, a big beat there. But revenue?
Revenue was basically flat compared to last year. Came in at $1.51 billion. That was just a hair under the consensus, which was maybe $1.53 billion. So a tiny miss.
Right, so help us square that. Flat volume, maybe even down slightly. Ongoing cost pressures in the auto sector. How do they deliver a 33% earnings surprise in that environment?
And that's the whole story of the quarter, really. The market just shrugged off that tiny revenue miss because AXL showed incredible discipline. It's all about execution, expanding margins, and generating cash.
So not growing the top line, but making more from what they have.
Exactly. In this kind of inflationary world, pulling off that kind of beat without volume growth, it tells you management has a really tight handle on costs and, importantly, the product mix. They show they can manage the things they actually control.
Okay, let's dig into that operational discipline then, because that seems to be the engine behind this quarter's positive surprise. Where did they find that leverage for better margins?
It really shines through in the adjusted EBITDA number. They hit $194.7 million.
And the margin percentage?
That translated to a 12.9% margin. And here's the really impressive part. That's a 130 basis point improvement year over year.
Wow, 1.3 percentage points better.
On flat sales. That's the kicker. For an auto supplier battling higher costs for everything, getting 130 basis points just from efficiency and mix. That's genuinely strong. That's why the stock popped.
Okay, 130 points is definitely significant. Where did that come from specifically? Was it cutting costs or was it selling more profitable stuff?
It looks like a mix of both, but the driveline business unit was the real star.
Driveline, right, their core business.
Yeah. It hit a 14.9% adjusted EBITDA margins. That's the best Q3 for that segment since way back in 2020.
Okay, so almost 15% margin in driveline. How'd they manage that?
Well, favorable product mix was a big part of it. We can talk more about that. But also pretty aggressive cost control. Management pointed specifically to optimizing R&D spend.
R&D. They cut spending there.
They lowered it by about $3 million year over year, just in Q3. And for the full year, they're expecting R&D to be down almost $20 million.
Now, wait a second. Cutting R&D to hit quarterly numbers. That can be a bit of a red flag, can't it? Are we worried they're sacrificing future innovation for short-term margins, especially with the whole EV transition happening?
That's always the question, isn't it?
Yeah.
Management framed it as optimization, not just cuts. Streamlining engineering spend.
So trimming fat, not cutting muscle.
That seems to be the argument. And look, given their strategy of being propulsion-agnostic, serving both ICE and EV and leveraging their strong position in combustion engine tech, maybe the market's giving them the benefit of the doubt for now. They see it as smart focusing, not totally disinvesting. It definitely helped the Q3 numbers.
Okay. And that focus on profitability, it flows right into the balance sheet health, which is super important with this massive Dowlais deal hanging out there. How did the cash flow look?
Cash flow was solid, yeah. Reflects that operational performance. Operating cash flow was $143.3 million.
And adjusted free cash flow?
$98.1 million. Good generation. And that lets them keep a lot of liquidity on hand, about $1.7 billion, and crucially, keep paying down debt.
Right, deleveraging. What was the net leverage ratio at the end of Q3?
It ended around 2.6 times LTM adjusted EBITDA. That's a key number. Before you take on a huge acquisition, showing you can manage your debt is critical.
And management specifically talked about paying down more debt.
Explicitly. They said they're committed to using that free cash flow to deleverage further. That's exactly what investors want to hear before the company adds the Dowlais debt to its books.
Makes sense. Okay, let's shift from looking back at Q3 to looking forward. What did the updated guidance for the full year just for standalone AXL tell us?
The guidance was another positive signal, really backing up that Q3 execution story. They tightened the sales range slightly to $5.9 billion.
Okay, slight tightening there.
But the big news was on adjusted EBITDA. They raised the floor of the guidance range significantly, now targeting $745 million. The old floor was $695 million.
Raising the floor like that, that's a strong vote of confidence, isn't it? Suggests Q3 wasn't a fluke.
Exactly. It says they believe they can sustain that level of discipline and definitely boost management credibility. They also put the adjusted free cash flow guidance at $210 million.
And what are they assuming for overall North American auto production?
Their guidance is based on North American light vehicle production hitting 15.1 million units for the year. Seems pretty reasonable, maybe even a touch conservative given current trends.
Okay. Now, beyond the numbers, management spent some time talking about the broader environment. And one thing that stood out was this idea of an extended icy tail.
Yeah, they really leaned into that. They kept saying they're propulsion agnostic. They'll build parts for whatever sells, EV or IC. But they noted that right now, the bidding activity, the new business they're competing for, it's leaning more towards traditional internal combustion engine stuff than EV programs.
Interesting. So the slowdown in the EV ramp-up is actually playing to AXL's strengths.
It seems to be a real tailwind for them right now. It lets them sweat their existing assets, their factories, their expertise in traditional drivelines for longer than maybe people expected a year or two ago. Better factory utilization usually means better margins.
So, in a way, AXL is benefiting because maybe some other suppliers bet too heavily on a super fast EV transition that hasn't quite happened on schedule.
That looks like part of the dynamic, yeah. It's giving AXL a longer runway for their core, often higher margin ICE products.
And it's not just general ICE demand, right? They talked about specific mix benefits.
Absolutely. They highlighted strong demand for the big stuff, full-size pickups, SUVs, think heavy-duty truck programs like the big Ram platform. They actually secured a nice volume increase for a specific heavy-duty truck transmission program. That drives volume and that richer, higher margin mix we saw in the driveline results.
Got it. And that ties into another macro point they brought up, onshoring and trade policy.
Yeah, that was fascinating. Management sees real opportunities emerging there. They're positioning AXL to benefit from shifts in, geopolitics and regulations.
How so?
Specifically in their metal forming business. Things like forgings, castings, powdered metal parts that mention tariffs, USMCA rules. Basically, the trend towards needing more content made in North America. AXL is getting ready in case those domestic content requirements get tougher. That could be a structural advantage down the road.
Okay, interesting angle. Now, we have to talk about the elephant in the room. The massive Dowlais GKN automotive combination. That's the huge catalyst everyone's watching. Q3 had some big news on that front, right? De-risking the deal.
Huge news, yeah. The biggest step was securing all the permanent financing needed for the acquisition. That was a major hurdle cleared.
How much did they raise and how?
It was a pretty complex deal structure. They raised $850 million in secured notes, another $1.25 billion in unsecured notes, and took out $835 million in term loans.
Okay, different types of debt. Why structure it that way?
It's about building a stable, long-term debt profile and appealing to different investor appetites. But here's the clever part. They didn't just raise the cash. They immediately used a chunk of it to pay off all their senior notes that were due in 2027 and some of the ones due in 2028.
So they pushed out their debt maturities, kicked the can down the road, basically.
Exactly. It buys them breathing room. The weighted average maturity of their senior debt is now well over 6 years. No major debt cliffs until 2028. That takes a big financial worry off the table right as they're about to embark on this complex integration.
Okay, so financing secured, debt profile managed, that leaves the regulatory approvals. How's that process going?
Making steady progress. They've got the green light in 8 out of the 10 jurisdictions needed. That includes big ones like the EU and Brazil.
So just 2 left.
Just 2 hurdles remain on the antitrust front, Mexico and China.
What's the timeline look like for those, and when do they expect the whole deal to finally close now?
Mexico is expected sometime in Q4 this year, 2025. China's looking a bit later, maybe late 2025, or more likely now, early Q1 2026.
So that pushes the final closing date back slightly.
Yeah, the target for closing the whole deal is now Q1 2026. But, importantly, management sounds very confident they'll get those final clearances. The strategic goal hasn't changed. Merge, broaden the tech and customer base, get bigger, and go after that $300 million synergy target.
Okay. Which brings us perfectly to our not financial advice segment. Given everything we've discussed, the strong Q3 execution, the raised guidance floor, the Dowlais deal getting significantly de-risked on the financing side, what's the outrageous but plausible trade idea you've cooked up?
Okay, I'm calling this one the IC execution arbitrage.
Intriguing name. Lay out the thesis.
The idea is go long AXL. Pair that with a targeted short position against a supplier that's really heavily betting on that shall we say, slightly delayed 2026, 2027 EV ramp. Huh. You know, one of those companies priced for perfect hockey stick growth that hasn't quite materialized yet.
Huh. So betting against the EV hype in favor of AXL's current performance, why that specific structure?
Look, AXL is proving right now they can control costs and nail their product mix. They're riding that unexpectedly strong wave of demand for big ICE trucks and SUVs. The Dowlais financing is done. The regulatory path, while slightly delayed, seems pretty clear.
So the long AXL part is about execution.
Right. And the short hedges things a bit. It hedges against any remaining geopolitical hiccups with those final Mexico-China approvals. But more fundamentally, it's a bet that AXL's deleveraging path, combined with actually delivering on those Dowlais synergies, will generate better returns than some of the pure-play EV suppliers who are maybe priced a bit too optimistically right now.
Got it. So the core idea is that AXL's proven current profitability and control is a better bet right now than the hope of future EV growth from companies still wrestling with scaling up and maybe burning cash.
That's the arbitrage. Betting on the company that's delivering today versus the ones banking everything on growth that keeps getting pushed out.
Okay, so wrapping this up for you, the listener, the AXL Q3 story really boils down to strong execution and smart risk management. You got that clean EPS beat, driven by really impressive margin improvement in their core driveline business. And crucially, they locked down the financing for the huge Dowlais deal, pushing out debt worries. It's a narrative of control.
Yeah, that control narrative is powerful right now. AXL showed they can manage costs and boost margins even when sales are flat. But, and this is the big but looking forward, the game totally changes post-Dowlais. They're almost doubling the size of the company.
And betting big on $300 million in synergies.
Exactly. So the big question shifts now. It's not, can they execute Q3 suggests they can? It's, can they integrate? Can they actually capture those massive synergies from merging with GKN while also keeping their eye on the ball with their core business profitability and navigating the ups and downs of this extended IC's tail they're benefiting from now? That integration execution, that's the main challenge, the primary hurdle for AXL in 2026 and beyond. That's what investors need to watch.